When companies think about international shipping, they usually focus on moving products from point A to point B. But there's another important part of the process that often gets overlooked: cargo insurance. More specifically, who is responsible for it? It sounds like a simple question, but in global trade, the answer depends on several factors. If the responsibilities are misunderstood, businesses can end up exposed to much more financial risk than they expected. In this video, we're going to break down what cargo insurance is, how Incoterms affect responsibility, and why understanding risk transfer matters in international shipping. International shipments go through a lot before they reach their destination. Products may move through warehouses, ports, cargo terminals, trucks, ships, and multiple handling points along the way. And every stage introduces some level of risk. Shipments can be damaged, containers can leak, cargo can be stolen, and weather or transportation issues can interrupt delivery unexpectedly. That's why cargo insurance exists. Its purpose is to help protect the financial value of goods while they're in transit. But here's where the confusion usually starts. Many businesses assume someone else is automatically covering the risk, and that assumption can become a problem very quickly. To understand who is responsible for cargo insurance, first we need to understand Incoterms. Incoterms are internationally recognized trade rules created by the International Chamber of Commerce. They help buyers and sellers clearly define responsibilities during international transactions. Think of them as a shared rulebook for global shipping. Incoterms determine things like who arranges transportation, who handles customs responsibilities, who pays certain shipping costs, and most importantly, when risk transfers from seller to buyer. That transfer point matters a lot, because once risk transfers, the financially responsible party changes too. Let's look at a few common examples. EXW or Ex Works. The buyer takes on responsibility very early in the process. FOB or Free on Board. The seller remains responsible until the cargo is loaded onto the vessel. CIF or Cost, Insurance, and Freight. The seller arranges transportation and insurance to the destination port. DDP or Delivery Duty Paid. The seller takes on the largest amount of responsibility, including delivery and import-related costs. Each Incoterm changes the risk exposure for both parties. That's why understanding your shipping terms is important. Because if you don't understand your Incoterms, you may not fully understand your liability. Another common misunderstanding involves carrier liability. A lot of businesses assume that if something happens during transit, the carrier will simply cover the loss. But in reality, carrier liability is often limited. Depending on the shipping method and carrier agreement, reimbursement may only cover a portion of the shipment's actual value. That means a business could lose a high-value shipment and recover far less than expected. Cargo insurance helps close that gap. A properly structured policy may provide broader protection for things like physical damage, theft, weather-related incidents, and other unexpected transportation disruptions. The goal is not just compliance, it's reducing financial exposure and protecting business operations. So let's recap the key points. Cargo insurance helps protect goods while they move through the global supply chain, but responsibility for that insurance depends heavily on the agreed-upon Incoterms. Those terms determine when risk transfers, who becomes financially responsible, and who should secure insurance coverage. It's also important to remember that carrier liability and cargo insurance are not the same thing. Relying only on carrier liability may leave businesses exposed to significant financial risk, The companies that manage this well usually take a proactive approach. They understand their Incoterms and they review their exposure regularly. They also make sure their insurance strategy aligns with their actual supply chain risk. Because in international trade, understanding where responsibility begins and ends can make a major difference.